Okay, good morning, everyone. Good morning, clients. It's time for our next, it's time for our weekly webinar. Okay, so today we're going to talk about some company updates as well as the macro and TA updates. Okay, so here we go. Disclaimer. Okay, so the first thing will be an update on Silverlake Access by Colin.
Hi, morning everyone. Welcome to our weekly morning webinar. Today we'll give some updates on two of the companies that's under our research coverage, followed by some updates on the economy, and after that we will go more in depth on technical analysis of the market. Right. First, this to give an update on Silverlake Access. For the quarter, revenue has gained 25% year-on-year at 138 million ringgit, mainly due to the higher software licensing as well as maintenance and enhancement services. For the full year, revenue has gained 26% year-on-year, which is above our estimate of about 2.8%. Growth in all segments apart from software project services has contributed to the strong growth in revenue. However, on upside, management has guided that the software project services is expected to pick up in the current fiscal year 2015 due to executions of projects that have been secured in the last fiscal year, and also as well as expected commencement of the OCBC Wing Hang post-merger implementation project. So this will help to contribute to the growth in software project services. For the gross margin, on the full year basis, the gross margin was lower, about 61.3%, was mainly due to the drag downs in the first and the third quarter, due to lower margins from certain projects. On the bottom line earnings, for the quarterly earnings has gained very strongly at 24% year-on-year, while full year earnings have gained 27% year-on-year, which is above our estimate of about 3.7%. Final dividend has been declared at 1.2 cents. Note that this is in Singapore currency, also along with special dividends of 0.6 cents, in view of the strong fiscal performance in the year 2014, as well as a high net cash balance that's close to 400 million ringgit, right? So this will imply that over 3.9% dividend yield, right? Assuming that current interim and future dividends are maintained, this will roughly imply that of dividend yield of more than 3% at current share price, right? So just to share some of the key growth drivers that's driving the growth in Silverlake Access will be coming from upgrade of older core banking system, which management has shared there's potentially 300 banks in the region that are still relying on these older and legacy systems. Also, there will be we do see growth coming from enhancement on existing systems from Silverlake's existing customer base. They'll mainly be coming as banks will be adopting a more customer-centric experience as employ more multi-channel, especially on internet banking, as well as the increasing need of and systems for risk management as well as compliance. Also, following the Malaysian government's decisions to introduce the good and services tax in Malaysia, we do see that this will also boost enhancements on accounting software, and these also will include banking system as the software will need to be GST compliant by 2015. Right. Also, regionalization and consolidation of ASEAN banks will also help to drive the growth in Silverlake axis. And also, another growth driver is that the group will leverage on Merriman, which was recently acquired in the last fiscal year, and this will help to drive strong growth in its insurance processing business, mainly in Indonesia. Right. However, in view that the valuations is not, it's quite on the slightly high side, we are maintaining our accumulate rating with with our target price of $1.32, while we still continue to like Silverlake access for strong balance sheets, growth, potential growth, as well as recurring revenue streams. Right.
Hi everyone, here's an update on Heng Heavy Machinery. They announced their full year earnings last week on Thursday. Okay, so essentially, okay, in terms of fourth quarter, they were just a tad disappointing. Okay, fourth quarter this year versus fourth quarter last year, a small drop in trading revenue of 4%. Okay, to 12.7 million Singapore dollars, and rental revenue down 6%. Okay, this is just the fourth quarter. Okay, in terms of the full year, which is much more important, you'll see that they have successfully executed on their overseas expansion, and this is reflected in their trading revenues, which is actually up almost 25%. Okay, since 1 year ago, to 165 million. Okay. So this is due to better than expected overseas sales. However, in Singapore itself, the construction slowdown is still here, and that's casted a shadow on the results. It's a drop of 10% revenue year on year. Okay, other nuances in their results is this: there was a drop in service income. Okay, but this drop was offset by increased rental segment margins due to decreased maintenance costs of their fleet. So taken together, you essentially have a small net profit growth, which is flat. Okay. Now adjusting for currency forward gains and losses, the net profit adjusted is only 1.6%, so it's very flat. Now just please recall that when we initiated 1 year ago, that the earnings assumption was actually for flattish to single-digit growth for FY14, and that's what we have now. The double-digit growth in earnings is expected to be in FY15. So FY14's adjusted net profit was actually within the lower range of expectation. All right. However, the slower than expected rental opportunity in Singapore does decrease visibility for FY15's rental, and that does cast a shadow on their successful rate of overseas trading growth. So a more detailed update will be available after this week's analyst briefing. At yesterday's closing price of 20.5, that implies 8.2 times adjusted trading PE. So it's not expensive. However, the growth prospects of the company, in lieu of the slower than expected rental opportunities, and as well as whatever plans they have for further regional expansion, will be all under review. And the target price may possibly be guided slightly lower, but we only can know this after the analyst briefing. Okay, next I'll pass the mic to Lin Xin, who will talk to us about China economic data.
Morning everyone, this is Lin Xin. Just a quick update on China. So for China, after policymakers announced a series of pro-growth stimulus to show up growth in the near term, we see mixed economic data in July. As you can see that here for the GDP, economic growth actually edged up to 7.5% on year in the second quarter, picking up from the 7.4% expansion in the first quarter, matching Beijing's annual growth rate target. Economy actually expanded 2% from the previous quarter on a seasonally adjusted quarter-on-quarter basis, while first half growth in 2014 was recorded at 7.4% from a year earlier. So this actually shows good momentum of stable and moderate growth in the first half, And as for the PMI, you can see that both manufacturing as well as the services PMI are actually hovering above the 50 level mark, indicating expansion are still in place. However, for the HSBC market survey, the private survey, the manufacturing PMIs are actually above 50%, showing expansion, but for the services sector, it's actually at 50 point, showing stagnant. At here, we don't have the HSBC chart. Just to update you guys on that. In addition, you can see that from here, the industrial production, it actually rose 9% on year, while retail sale from here, it increased 12.2% in July, albeit both indicators actually shaved off 0.2 percentage point from June's record. As for the fixed asset, although that China has been fast tracking to accelerate on their public spending, we can actually see that it's actually trending down. As this fixed asset investment is actually a gauge of government spending on infrastructure, is easing slightly from 7.3% reading to 17% on year in the first 7 months. However, overall, the sentiment remains upbeat despite the contrasting data. As you can see from here, we expect to see that there are more tailwind from the steady global recovery. As you can see that the exports continue to outpace imports due to encouraging demands abroad, as well as partly due to the yuan depreciation last month. Yuan actually depreciated about 1.7% against USD this year. We expect to see that this may intensify costs from the US exporters to let renminbi appreciate, because the depressed renminbi gives the Chinese exporters an unfair advantage to the others. So overall, we can, to sum up, we can actually see that in July, we have the largest monthly trade surplus at about 47.3 billion. And we expect the strong overseas demand to partially offset the subdued domestic activities here. On the other hand, I don't have the inflation chart on at the moment, but just to keep you updated, inflation remains moderate at about 2.3% on year in July, well below of government's target at around 3.5%. Meanwhile, the producer price index continued to decline for the 29th consecutive month in July on soft market demand. This is actually aligned with these three charts here. So we expect there will be more fine-tuning policy, which is also dubbed as the mini stimulus measures, as well as the reforms. We expect that this will continue to lend support to the underlying trend of economic fundamentals. Okay, moving on. Okay, on the equities market, you can see that we expect that there will the main catalyst here will be the reforms. Reforms will be the will remain as the key theme for the Chinese market. In particular, the Shanghai Hong Kong Stock Connect, which we expect it to go online on October 13. There are currently some problems faced by both China as well as Hong Kong side in terms of the settlement, the tax stance, as well as costs. At the moment, China imposed 10% capital gains tax on all stock purchases made on the mainland, but this tax has never been collected on shares purchased under a range of cross-border foreign investment programs, including the RQ fee. Meanwhile, Hong Kong does not impose any capital gains tax on shares purchases. So currently, both sides are coming to an consensus on the new tax rules. We are remaining cautious on the news. Meanwhile, we are actually quite bullish on the A shares as A shares, Chinese stocks are restricted to the domestic market. They are considered as cheap and has a slower reaction to the market. Okay, for near-term risks, it remains as the cooling property market. The slowing real estate market will continue to drag on the market, on the Chinese market, and is sending ripple effects to the construction sector as well as other housing-dependent industries. It would also magnify the slackening imports as well as decelerating retail sales. So we might see a dampening investment as well as bank lending. However, we maintain our view that we do not expect a hard landing in this nature. There's another near-term risk that in regards to the premature tightening of US interest rates, which may send a jolt to the market. But on the flip side, the tighter monetary policy would signal a US recovery, which would bode well for the country's exports. Okay, just to sum up, with regards to, we are expecting more economic reforms, structural reforms, particularly for the SOEs, and this will set to unlock greater value over the long term. And liberalization of interest rate should encourage more private investment to support economic growth. So at the moment, in conclusion, we upgrade China to overweight from neutral weight, and these are the few mutual funds as well as ETFs that you can invest in, which proxy China. So with this, I would move on to Eurozone, to my colleague to talk about Eurozone.
Morning, everyone. This is Sam, and I'll be doing a macro Eurozone review. So, okay, we recently downgraded Eurozone from overweight to neutral weight. I'll go through some of the reasons why we did and what made us to actually downgrade Eurozone. So, Eurozone's feeble recovery came to a halt in the second quarter, which the result were quite disappointing. And the major and the most the major surprise came from Germany, which actually posted negative return, the growth return of negative 0.2%, which most of the economists and analysts wasn't actually expecting. Meanwhile, early estimate of the Italy revealed that it had already slipped back into recession with a second consecutive contraction of negative 0.2%. So with that in mind, Eurozone's top three economy, including Germany, France, and Italy, they were all down in negative territory. Spain, on the other hand, Spain, Netherlands, and Portugal partially managed to offset the deficit by recording positive growth. But even then, the overall growth of Eurozone wasn't anything that was being expected of them. The purchasing manager index, the PMI, and the industrial production data were weaker as well. And the PMI itself was down for the fourth time in the last 6 months, including this month as well. Germany's industrial output was down 1.5% in the first 2 months of the second quarter compared to the first quarter. Eurozone unemployment rate actually fell to 11.5% compared to what it was hovering around 12.5%, which in a way, very small way, and is an encouraging sign. because it mostly came out from Spain and Italy. The decrease actually came from Spain and Italy, but 11.5% is still itself is a very huge number, and we don't expect it to be reduced by a margin in coming months or so, considering the general economy of the Eurozone itself. Okay, inflation, which is the second biggest risk right now, remains well below ECB's medium-term target and fell to 0.4% in July. Actually, last Friday, it fell further to 0.3%. That was the lowest in the last 5 years, 0.3%. Which it fell in August. So that has become one of the biggest risks right now. ECB is looking into it very seriously because any further decline will take the whole Eurozone into a deflationary phase, which I don't think any country or region would want at this point in time. Moving on to the bond market. In the bond market arena, the search for yield combined with the reduced threat of a dissolution of the Eurozone has led to a surge in demand for European periphery sovereign debt. Similar to that, a global search for yield has also driven demand for higher yielding credit. Now, if you look into the chart on the right-hand side, you will notice that the yields, bond yields, have come down by margins, and even for those periphery markets, including Spain, Italy, you would see the bond yields have fallen to, they're actually down to historical, below average, historical average actually. And one of the reasons for higher yielding bond demand is because of the low default rate actually prevailing right now. In short, the level of credit growth in the Eurozone is woeful, and as a result of the ECB's comprehensive assessment remains some months away, a surge in credit activity is unlikely, because banks right now are reluctant to lend money until their comprehensive assessment, the AQR results, are out, and they know how much capital they need to put on reserve in order to meet the ECB requirements. And ECB did finally implement the negative deposit rate for the bank reserves, and now further plans to introduce a long-term bank lending program, LTRO, this month. We believe that the negative deposit rates and the LTRO together will have some impact on the credit activity. Plus, when the AQR results are out and banks are kind of have a better plan to go with, they will be more willing to lend the money to the actual end user. So in our view, ECB will wait until next year to gauge the impact of negative deposit rates and the LTROs, and only then will implement QE if needed. So although talks are on the way, and you might have heard on news and everywhere that Mario Draghi gives some hint about, like implementing QE, but we still believe it will take some time because they still need to wait and monitor the impact of LTRO and the negative deposit rate before they can move on to the QE. Okay, so earlier I said that inflation remains the second biggest risk to the Eurozone area. Now, which is the first biggest risk? It's a geopolitical crisis. Germany has been most affected given the close trading ties between the two countries, namely Germany and Russia. The sanctions will likely create a limited but unwanted drag on the European economy. Now, although having said that, the recent trade embargoes with Russia has not impacted Eurozone imports completely yet, but you might notice that they have already started hitting the confidence level, whether it's business confidence, it's consumer confidence, and that has prompted corporates to hold back or delay capital investments, which is not good. another thing, excluding Latvia, Estonia, and Finland, which are heavily dependent on Russian export and import, most of the core economies, which although export more than the peripheral economies, are still very modest in their export to Russia compared to the rest of the world, implying that it would take large fall in Russian imports to have a material impact on GDP growth there. On the chart right-hand side, you can notice that the imports and exports compared to the GDP of Eurozone has both fallen by a margin, but imports have fallen more than the exports. And same goes with the, if you look into the second chart, you will notice that the imports from Russia compared to the total Eurozone import have quite been stable in, like going sideways, while on the other hand the exports are down compared to the rest of the Eurozone. So it's telling something that because the confidence level is hit, the industrial side isn't doing, the manufacturing side is not doing well, and that is the reason their exports, their imports hasn't been declined more than what their exports have declined with Russia. Now, in my report, if you take a time out to read the report on Eurozone, you will notice that I have I've written the thesis on geopolitical crisis, and I've talked about different scenarios, what can happen in the consequences to the Eurozone economy. But based on these events in data that we have right now, we have decided to downgrade it to a neutral rate until we start to see something coming out from the monetary end and plus from the industrial manufacturing sector and from the geopolitical scenario. We have also mentioned a few of the unit trusts and ETF available that proxy Eurozone. It actually proxy the entire Europe area, which you might be interested to look into. With that, I will pass this presentation to my colleague to talk more about the technical analysis stuff.
Hi everyone, it's Kenneth again. So it's time for a technical update. Okay, market technical outlook for September. Still updrift on liquidity, and good news. I'm focusing on just the STI and the S&P today. So in lieu of all the economic data which you just heard, where do we see the cycles going on? So I'll just start with my conclusion. Essentially, the economic indicators and intermarket picture clearly support a longer-term uptrend in stocks. And on a shorter term, they may still have a little bit more upside before some correction periods. And I'm going to talk about that soon. And today, I will attempt to give you an Elliott wave count on the S&P. This is just to show you to get the prior outlook for the year. You can get it from here. Okay, so just from February 2014, I just want to reiterate what we've talked about and how things have changed since then. So number one, the probability that the US market is in a bull market and it's not ended yet, well, that's been certainly true since then. Here, the STI has a chance to cycle up until the meaningful correction S&P starts. We've had a correction in August, but is not the major correction. So since then, the STI has indeed cycled up. We talked about a minor and major correction periods. The early Feb appeared. Okay, so now this period here has not occurred per se yet. The corrections have been a bit weak and limp. Okay, so no major one as yet. So the pattern so far has kind of changed, and so we need to evaluate how things are at this point in time. Don't forget, I did these probability targets based on February, right? So it's not exact, but it's probability period. Okay, here's the original slide for the STI that it did cycle up. Okay, so I mentioned that the STI has a chance to cycle up to the meaningful correction. Okay, let's go on further. So here it is now. Okay, here it is then. Here it is now. So you can see that the STI has continued to cycle up a bit small, right? As the STI, as the S&P continues its move up without a major correction. Okay, from the original slide in 7 July, which is the last time I reported, we did talk about the dovish central banks and the net good news, and so far these two sentiments have essentially been extended till now. Okay, this was the original slide to remind you in 7 July to show you the net good news versus bad news in terms of economic numbers in the US. Okay, this is also to show you how the bull had some more more to go based on July, because we see that the offensive sectors have been leading and the defensive have not been leading. So it tells me that the market has a bit more to go. Okay, so let's do the update. Now, before we do the update, let me just talk about an Elliott wave pattern. The thing about Elliott waves is that it's something that is easy. The basics of it is easily learned, but to apply it properly requires a lot. I would say a lot of reading and a lot of analysis. Okay, I don't have time to go through advanced Elliott waves, but those who are familiar with Elliott waves will know what I'm talking about. Now, what I'm going to say is a little bit subjective. I will admit that Elliott waves is a very subjective art. Okay, and many people will have different models. Okay, so I'm giving you a model based on the Elliott wave rules that does not violate the rules. Now, can there be other types of wave counts? Yes, they are. But what I'm going to do is I'm just going to show you what a possible Elliott wave count is based on how I see the other economic indicators and breadth indicators. Okay, now some people will disagree with me. In fact, some people say that this extended move that we've had from 2012 to now, that this is the last move. Some people will basically say that from 2009 to 2010, this is the 1, followed by 2, this is the correction down to the 2, and the move from mid-2010 to 2011 is the 3. They'll say this is the 3, this move down to 2012 is the 4, and this move up is the 5. In other words, this is the last move before a major correction and then bear market will start. Okay, I can see how easy it is to say that, considering that the all-time high is we've reached that, etc., etc. This move does seem a bit limp and long and limp. Okay, however, that violates, in my opinion, the Elliott wave. What is a better count, in my opinion, would be this. I believe that we are actually coming towards the end of a 3 of 3. That means this move here from beginning mid 2010 all the way till now, this whole move is actually an extended 3. So here's 1, here's 2, here's an extended 3. In other words, you have it's a 3 on 3 and 3. So this is a 3. In this is as a minor count, this is 1, 2, and then this is another 3. And in the minor count, this is 1, 2, another 3. So what does that imply? It implies that the 4, which is the major of the 4, like this sort of correction here, the next major correction would be a 4. And that also implies that after the 4, it's not the end of the bull market. There's usually a 5th move before the end. Okay, there are a few reasons why I will support my argument. Okay, but before I talk about the argument, right, just note that the 4 can be small, can be big. Okay, it's possible for the 4 to come all the way down here. I'm not saying it will, but I'm saying the 4 can. The only rules of the Elliott waves is this: basically, the 4 cannot overlap the 1, and that 3 cannot be the smallest wave. That's the reason why I think that this move here, between middle 2010 and 2011, this cannot be a 3. Because if this is a 3, it means this is the shortest wave. And technically speaking, 3s cannot be the shortest wave. In fact, it should be the most impulsive. In theory, should be. Okay? So that's why I think that this whole thing's a 3. Okay. Now, for the 5, just to note, a 5 doesn't necessarily have to be long. It can be short. In fact, if this is in fact a 3, probability is that the 5 is going to be short. Because those who are familiar with Elliott waves, I mean those who have basically read the theories behind Elliott waves will know that every time you have an extended move, let's say the 3, 1 and 5 usually have the same length. It will not be extended. It's very rare to have 2 extended moves. So the 5 is probably shorter than this move here lah. Okay, and also it's not necessary that after the major correction that the 5 can actually exceed the high. Not necessary. The 5 actually can reach like a double top, or can even be smaller. It's called truncated fifth. Okay, but the point of it all is that the next major correction, which is the 4, shouldn't signal the start of a bear market yet. That's the whole point I'm getting at. Now, the reasons why I say so is a few reasons. We're going to see that intermarket supports that. We'll see that the yield curve is far from inversion. And then also, this breakout of the all-time high, past 15,500, 1550 over here in S&P, this is a true breakout, right? You can see it's definitely a true breakout, which means it's possible to put a price objective onto it. We've talked about price objectives in our previous lessons. Maybe next month when I do a complete TA lesson, I will talk about that again. But the objective from this breakout implies a further move around 2400 plus or higher, depending if you're using a log scale or not. So this coincides well with the Elliott wave, which I think we are on. Okay, I hope that wasn't too confusing, but let's talk about the rest of the stuff. Okay, so just to reiterate, this is our stand since January, and we still stand by this. We're still in phase 4, which corresponds to the, where we are on the Elliott wave. Okay, we talked about intermarket relationship, that we are waiting for the US Treasuries to really sell down and increase the yield as the economy improves. We're waiting for this to break down while the industrial commodities consolidate and break up. Okay, so we've had that. Okay, since then, you can see this is what the chart looks like now. We've had a breakout. So basically, the economy wants to recover, activity wants to increase. But then lately, we've had yields increase again. Yields decrease at once, go up in price, followed by a drop in industrial commodity prices. Okay, this is due to a few things. Eurozone inflation is at a 5-year low, and based on the fallout of the Russian and German stock indices, these are things, and the Eurozone being weak economically, right? I think this has basically been one of the reasons why industrial commodities have been dropping. But what does this mean for our bull cycle? It means essentially that you can say the life cycle of the bear market is actually extended, because at this part of the economic cycle, unless the Eurozone goes into a full-blown crisis, what's going to happen is that we're still going to be on this cycle where central banks are going to do whatever they can to stimulate the economy through liquidity or monetary policies, right, until the economy recovers, right? And that's still a bullish, that's basically a bullish, fundamental positive base for stock market to basically continue its move. This is just for your reference, just to show you, I guess it's a tip or a guide, that in general, relative strengths of the different sectors go in sequence relatively, and you actually can see this pattern here. For example, cyclicals, you can see cyclicals turn down, this is relative strength, right? It turned down here in 2014. Yeah, see, look at industrials, right? It turned down later, 6 months later. The materials have not turned down yet. Right? See, and energy is actually on the rise now. See, so this phenomenon does exist at this part. It's interesting to look at. So we just reiterate that here's where we are on our sector rotation cycle, stock market cycle. Yield curve here, as you can see where we are right now, yield curve is still nice, healthy with a big spread. Okay, very far from inversion. All right, near zero short-term interest rates. Long-term interest rates even dropped a bit. So long-term interest rate dropping a bit means that inflation is even less of a risk now at this point in time. Okay, so since July, here's the performance of different of the asset classes here. You can see that here's the GSCI energy energy index, right? It has dropped almost 7% since July. And even livestock has dropped 10%. These two gauges form the bulk of inflation. As you can see, inflation is hardly a risk. Now, however, we're not going into deflation yet. Okay, and it is positive that the industrial metals, right, is still positive in that period of time. So there is still industrial activity, and inflation has decreased. So this is another reason why we think that the bull cycle is basically it's going to be longer now, a bit longer. And I just want to reiterate, a longer bull cycle doesn't mean that there's no correction. It just means that it's just going to take a bit longer, that's all. Okay, from July, this is the picture I painted. Basically, I said that there was good and questionable, but the point of it all is that it's still an uptrend. Any pullback is still part of the larger uptrend, right? I talked about this in July. So any pullback is still part of a larger uptrend. Just put a stop at 1800 just in case, okay? Because if it fall is too drastic, then maybe something has changed, okay? So where we are right now. So essentially, same thing happened, right? We had a small pullback, okay? Didn't reach 1800, and then it continued on a bit more. So it drifted a bit more. So where we are now, on the short term and intermediate term, here's the thing. Short term, still a bit more, okay? Let's just talk a bit about technicals, right? Momentum implies a short-term move up. Your MACD is on the verge of turning here. RSI is not oversold yet, overbought yet, sorry, it's not overbought yet, and RSI has been in bullish territory. So it implies to me that there is definitely enough ammunition to go a bit further up. Okay, however, I do expect that when this hits the top channel, I don't expect it to break through the top channel because I see I see some weaknesses underlying this move over here. So second of all, if you thought, you can see in this move up here, my sensitivity index, right, has dropped further or has not accompanied this move up. I expect to see this improve dramatically for me to believe that this can actually continue for a longer time. So this is some weakness over here. The VIX is also at a multi-year low again, so once again it's too complacent. Volume has been decreasing, and later we'll see investor intelligence getting extreme soon. Okay, so what does that mean? It means possible for a little more upside drift, okay, but protective stops should be in place. So basically it's still an uptrend, but if you're trading this, please put a tight stop, maybe put a stop at 1900 over here, okay? So you raise the stop from 1800 to 1900 over here. Okay. Here's the S&P again. I just want to show you that we are approaching the top channel soon, and the odds are that we will probably hit the top channel before anything happens. Okay, so because right now the economic data has been very, net has been, sentiment is quite positive in the US, so we think that this can probably hit the top here before changes are made. The advanced decline line has supported this move as well. However, okay, in terms of investor intelligence, right, the bull-bear ratio, we see that we are still euphoric, higher than 3, but not as euphoric as the 2 corrections before that. See, the 2 corrections here and here, these 2 peaks here preceded corrections in the market, and we're not there yet, okay? But we are getting there. So that's why I think that we can still go higher, but soon we'll probably reach these levels over here. Now, don't forget that for your reference, every time that the bull-bear index was 3 or more, it always preceded some sort of correction. The only question is just whether the correction was a minor one or a larger one, but there usually is some sort of correction. And we're kind of there again, or coming soon, not yet. For your reference, this is what happens when the bull-bear ratio is under 1. Okay, we're probably going to have, actually, we are probably going to have advanced TA lessons in January next year. So if you want to learn more about all these things I'm going to talk about and how to time market cycles, I'm going to be giving a class, but more details will be done in the weeks to come. Okay, so just bear this in mind. So all those people who have requested for TA lesson, it's coming soon. We've heard you. Okay. Okay, SG market. Now that we talked about the S&P, okay, let's talk about the SG market. So just to reiterate, since February 10th, this is the price chart, and here just to give you to show you what we've been doing so far. We talked about a short-term bounce slightly from here, and we've had that short-term bounce as follows. Once a bounce occurred, we did mention that this is now resistance. Okay, we're going to have a short-term cycle down, but as long as the US market does not correct, we think there's an upside bias to it. So since then, we can see that there is some sort of move. It's still in the resistance zone, hasn't broke out yet. We think that this is just a little bit weak here. We see 2 weak candles over here, plus the MACD might turn a little bit. It's turning a bit now. So likely what's going to happen is that we're going to consolidate in this red zone a bit more, unless but as long as the US doesn't correct, right, this will probably have an upside bias for now. Okay, but maybe at this point in time, you need to see whether this resistance can be broken. If it is broken, then the upside target is like the 52-week high. Okay, this will be the next target if that's broken. Probability on the longer term is to the upside because numerous markets have already exceeded 2007 high. Okay, US, Taiwan, Malaysia, and now even China shows signs of bottoming out. Okay, so sentiment is slowly returning. Okay, sorry. So this is the 1st September chart over here as follows. Okay. Oops. Okay, and that is it for now. And so now we shall welcome your questions. Oh. This one? Okay. Okay, I'm going to answer since I'm here. Okay, let's talk about Valuetronics. How is Valuetronics? Okay, yes, I know there's been a sell-off. Very interesting, nice market sell-off. The thing is, there isn't any new news per se. The only news that's been out is basically when the company reported its quarterly results, and of course all the houses came out with their research data. Since then, there actually isn't any new news. Okay, so there is a sell-off, and we just think that this is basically market technicals into play. But my suspicion is essentially, even though Valuetronics is inexpensive, but because but earnings visibility is just a little bit less clear than before, because now you have two very strong drivers but on opposite sides. The CE segment, right, looks to be impaired, really impaired because of decreasing margins and sales slowdown because of increased competition. So on one hand, you see this structural competition coming in, and that probably scares some of the market participants. On the other hand, right, it's easy to overlook the fact that the ICE segment, right, has also been growing by strong double digits, 20-30%, and that the ICE segment, right, is actually the gross profit from the ICE segment is now even higher than CE. So the combination of the two gives it flat growth. But I think there'll be a proportion of market participants that will focus more on the CE segment, and I'm assuming that these are the people that have been selling off. Okay, but also realize that Valuetronics have been rising for the last 1 year. It rose from 22 cents all the way to 59 cents, and my target was 60 cents. So now this is a big retracement. I can only advise you on the technicals because the fundamentals haven't changed yet. Technically speaking, we are at a retracement level already. Now, I don't know whether you would buy more now, but I would not. As a technician, it's a bit hard to sell at this point also. Let's just put it that way. Okay. Another question, do I do an Elliott wave count on Shanghai index? Okay, the reason I do not give an Elliott wave count. Now, the reason why I don't give an Elliott wave count is because Elliott wave counts is really an art. And to get the count right, you really need to cross-check your count with other types of data, be it economic data, be it what you understand of the actual market itself, etc., etc. This data in the US is much more readily available, and it also takes a long time to come out with this thesis. So that's why we choose to focus on the US market, because we find it's the biggest market, and it's one of the biggest drivers in the world. So at this point in time, we do not have an Elliott wave count on the China market. Okay.
Okay, there's a question now for China. China July monthly trade surplus. Also, yeah, yes, July's monthly trade surplus, the huge trade surplus was partly also the result of a lesser import. There's actually a weakening in imports due to the slowing property market. And we continue to see that the property market will remain as a drag to the economy. So yeah, and at the moment, because due to a stagnating domestic demand, we would expect import to remain moderate. And the second part of the questions saying that also traditionally at this time of the year is current PMI number, even though above 50 presents a concern or suggests some weaknesses. The PMI data, the official PMI data just released this morning. Although they are weakening, but they are still both the manufacturing PMIs are actually still above 50. Yes, new orders, everything are slowing down, but this is also due to the moderate domestic demand, and we continue to see that growth may be moderating in the near term, but we also expect that the government will announce more of these pro-growth mini stimulus measures to show up growth. Yep, if that answers your questions.
Question here on SGX new rule of a minimum trading size of 20 cents. How will this affect stocks below 20 cents? I think stocks, penny stocks, which have very little fundamentals relative to their stock price, are going to have to consolidate, and that will usually mean the share price will go lower. Okay, that's just speaking from market experience. Now, when you see a penny stock that's trading like a few cents, and you think it's cheap, right? And then after that, you go and if you dig further into financials, actually it's very expensive. Some of them, like even though a few cents, the NAV is almost zero. Okay, so maybe they're trading at 100 times NAV, something like that. Okay, or 100 times PE. All right, despite being a few cent stock. Right, always look at the fundamentals relative to the share price. What is that ratio? Okay, so if you see a penny stock that's below 20 cents, you know it's got to consolidate. Now, when you consolidate, that means you send the share price higher, and then that means there is more room to sell. Okay, so when you look at a penny stock which has a price that's close to zero, you can't really go down much further. That's why it doesn't fall. Okay, when you have to consolidate, the price goes higher, then you can sell more. All right, so that's what I think will happen to those stocks which have very poor fundamentals relative to their share price that are trading below 20 cents. Okay, there's a question here on Centurion. We don't cover Centurion, but we have been doing some research on it. So our opinion on Centurion is that the outlook is now clouded. And it is clouded because of a surge of supply in the number of worker dormitory beds. that means we can have an earnings fall, and it may actually, the price could actually go lower from here. Right now they're charging, I think, almost $300 a bid. Yeah. Okay, my analyst just tells me that doing his channel checks, one of the competitors priced at $250, which is $50 below Centurion, and still no takers. Okay. Now, the construction industry is going through a productivity shakeup, and because of that, the output for construction companies is much lower now, and they basically just cannot afford a $300 bid. That's a simple explanation of what's going on. Okay, hold on.
Hi, there's a questions on with regards to Silverlake. Which major banks are using their software besides CIMB and OCBC, and what's the current backlog like? Right. Apart from CIMB, OCBC, other major banks that are using the Silverlake systems includes UOB as well as Bank Mandiri, Maybank, right? And these are some of the big major banks in ASEAN regions that are actually using the Silverlake system. The current backlog is about 280 million ringgit, right? As shared by the management. So this has came down slightly as compared to the previous in the last fiscal year. But mainly that was due to the build up of the project execution of the CIMB's one platform. So going forward, we do think that the current backlog is still gives very good earnings visibility, which is able to sustain them for the next 2 fiscal years, and that's not even including the current project services that's to be contributed by the OCBC Wing Hang merger, as well as other enhancement of the existing banking systems. Right.
Hi, we have a question here just for an update on Croesus. Yeah, we're still positive on Croesus. They have an acquisition pipeline going. There is no change to our views on it since the last report. I think the forecasted earnings distribution per share is going to exceed 9 cents this year. So it's still going to give a very strong yield. On the acquisition pipeline, which they have long signaled, they have indicated that should they raise equity, it will be on an accretive stance. Okay, that means DPU accretive, and yeah, we're still positive on Croesus. Very good yield, very resilient defensive assets, basically retail malls in the heartlands of Japan, and areas which also have growing families.
Hi, it's Kenneth here again. Okay, question is, what is your target on S&P for wave 333? Oh man. Okay, wait. Let me go back to the slide. Okay, I can't give you a target on the 333 itself. Okay. But what I can say, okay, don't forget. I mean, edit waves is still an art. Okay. I mean, I can't give you an exact number. But what I will say is this, okay, based on the price objective from breaking out of its all-time high in mid-2007, if you project this objective up here, you will reach a target of roughly 2400. Okay, 2400. Now, this target can be increased depending if you use a log scale or arithmetic scale. Okay, so I'm just being conservative and using the arithmetic scale. So if you use an arithmetic scale, you find that the price objective is 2400. Now, this gels relatively okay with the wave count because after a retracement, possible retracement, okay, the 5, if there's a 5, is likely to be of the same magnitude or in terms of time as the 1, which is very short here. So it seems like after retracement and up again, it can hit 2400. Now, the thing about the wave count is that that's how it is right now. This is the thesis as of right now. As the wave pattern forms, right, the counting of it may change, right? That's the nature of the Elliott wave. But at least it gives us a good guideline. All right, so that's all I'll say now. The 2400 seems to be the price objective. Okay, and it may seem, and it seems like after the 4 and the 5, we can get to 2400. So I hope that answers your question. Unless something drastic occurs to change the whole pattern as I see it here, then we'll update you then. Okay, so as long as there's nothing really major going on, some crisis occurring, that's what we foresee in the future.
Hi, question here on triads. Okay, we also we visited triads management a few weeks back, so they are very bullish on the prospects of their business, right? Because they are, I think, maybe the only Asia-based lift boat maker, right, in Asia. Baker Tech is also trying to get into the space, but new and just starting. So I think right now it's all triads. Now, definitely there's a lift boat shortage in the market. So I think in terms of demand, or rather shortage in this industry, that's pretty good. However, we have noticed that the rate at which orders are being taken in for triads is not very robust. And what we think is that it's not that easy to operate a lift boat. Okay, you can't just buy one and then expect that an all major is going to allow you to operate that lift boat anywhere near them. I mean, you could cause huge damage to their oil rig if you mismanage the lift boat. Okay, so it's not so easy for someone to operate a lift boat. And because of that difficulty, I think that is actually holding back Triad's order book. Okay, as in, I mean, basically, people want to operate lift boats, but to get qualified to operate lift boat is not so easy, and that is restricting demand. That's what we see at the moment.
Hi, what's the question of Valuetronics again? What is the firm view of Valuetronics? The firm view is very simple. Okay, essentially just based on pure fundamentals itself and based on the evidence that Valuetronics has performed in this quarter and last quarter, that we have a fair value of, at this point, 59 cents. Okay, and that valuation is just based on FY15's PE of X cap, PE of 8 times plus 60% of its idle cash, which is a fair gauge. Okay, that's the firm value. However, in terms of market technicals, right, it doesn't necessarily have to. I mean, it may not. That's just the fundamental value which we perceive. In terms of market technicals, right, I mean, it can do something else. Okay, but if you want to know what we think the fundamental value is, it's that. Okay, in terms of the sell-off, I think it's just, I mean, that's what just happens when you have a move from 22 cents all the way to 50 cents. You're bound to have some sort of sell-off, and that's what we see now. Yeah. So anyway, at this point in time, it's still cash rich. You still have a dividend. I think the dividend is 6% at the present. At the present, stock price is 6+% now for the dividend. Yep. So I think that if you have a view of just a good dividend, that will be one of the plus points of Electronic, as it slowly transitions from a CE business to an ICE business. So there is some risk there in the transition, but throughout the transition, and you're likely going to have price volatility, but in this transition, at the very least, it's cash rich, and you will be supported by a dividend. Thank you, everyone. That's our webinar for today. So we'll see you next week, and have a good week.